Jyoti Jaipuria is now joining us, founder MD at Valentis Advisors. Jyoti, afternoon. Thank you so much for your time. See, some of your friends, you must be listening to them, are making a case now. In fact, RBI Governor too, last evening when we were interacting with him at the sideline of our 15th anniversary, mentioned that there are concrete signs that the rural distress is easing and there is recovery out there. What are your thoughts? You meet companies from all backgrounds. And also, do you have any plays in mind? What's the right way to play this rural recovery?
Yeah, so Ajay, like there are two things which will happen. One is hopefully the monsoons will turn out to be good, though, the June month has not been as good as people anticipated. But with La Nina coming in, El Nino being behind us, I think we'll have a good monsoon after poor monsoon last year. So that will be one important trigger which probably will help the rural sector. The other is probably post-election, the government has some wiggle room in the fiscal budget now because RBI gave them 2 lakh crores of dividend, which was an unexpected bonanza. So I think some of that surplus money from RBI will be used for more rural-oriented schemes without really hurting the capex which they had already planned in the interim budget. So I think these couple of things will help the rural sector do well. Now, obviously, there's a vast way of playing it. You can start with consumer staples, which I think are still expensive, but they'll also gain from this. There's the auto segment, especially the two-wheelers and the tractors. There will be the agrochemicals and the fertilizers, which will be paid from this. Agrochemicals are coming from a very low base over the last 18 months, so there could be some upside there. So these would be broadly three sectors to really play the rural recovery.
Breakout happening today in banks as well. Of course, leading from the front are IndusInd and HDFC. What are your thoughts on the entire lenders pack? Which part of lenders do you have in your portfolio?
We've liked the banking space over the last few months. And, our whole philosophy is the three U's. So we tend to buy stuff when it's undervalued, underperforming, and underowned. So for us, it was, yes, there is pressure on NIMS, but that pressure is well flagged into the market now. Valuations are factoring that in. And so, the banks look like a good space for us. So we've been splitting banks into two or three segments. Basically, one is the normal private sector banks, which we've been buying. The second has been the public sector space, where we have been, getting some good bargains. And the third, and that's where probably a larger part of our weight is, there are a lot of smaller private sector banks which are trading at low valuations. And there have been, management changes or, some effort made to revamp the bank. And to that extent, there's like a long runway where things will start looking good for them. Because if you think of the whole banking space, essentially what happened was banks cleaned up their balance sheet and a lot of the large banks were first in the race. And then they had a good smooth run over the last couple of years. Same thing we're witnessing with some of the private sector banks now, which probably were a little late to clean up their balance sheet, but now a lot of balance sheets are getting clean. So you still get banks which are less than one time price to book and which over the next 2 years will generate decent earnings and high ROEs. And that is the space which we are really focused on.
Right. Also, what are your thoughts on this entire market infrastructure related stocks, exchanges, stocks like KIF and CAMS, some of the other intermediaries as well as even AMCs and MF distributors? We have a bunch of them apart from just brokerages. So do you like anything there?
These are very interesting plays. And, one thing with them is there's a lot of, costs are fixed. So to that extent, as the market goes up, you get a lot of operating leverage over there. Like even our business is, somewhere in that space where operating leverage is high. There's one concern near term which we have on them. So, essentially we've come after 2, 3 years of a very good market. So to that extent, earnings have been very sharp for them. So have been valuations. So the question now is, are we paying, are we looking at close to peakish earnings? And are we paying peakish valuations for some of those peak earnings? Near term, I think, the one thing which I'll watch out for is there's been a lot of noise from SEBI as well as from the finance ministry that the whole derivative market in India is, getting a little out of control. So there may be some steps taken to, control the derivative market to reduce the volumes which we've seen there. And that could hurt some of these banks, especially the exchanges. So that's one thing which we'll watch out for in the budget. And, till then we are a little cautious on some of these names.
Just a while back, we had a chemicals analyst talking to us. Still, not very convinced. This is more an industry guy rather than a stock market analyst, but says that no concrete signs of the overall pricing bottoming out or even inventories bottoming out. But what are your thoughts? We believe that you started, studying that space. What are the signs you would look for, and which are the kind of companies would you start nibbling in? Is it the larger ones or even the mid-tier ones?
So yeah, Ajay, you're right. Like for us, on our screens, all these things come up whenever they do badly. So in some sense, it's getting, underowned and it's getting underperformed. So what we keep monitoring is the stock level at the dealer level. So, the stock level is still high. It's not back to normal levels. But at the same time, the stocks are lower than what they were, like, say, 6, 9 months ago. So to that extent, there's been some drawdown of the stock and there's something still left. So based on our like rough number, a lot of these are like very rough estimates you have. We think probably like the stock level at the dealer level will get around normal by the end of this calendar year. So that's where, this will get normal. Hopefully by that time, we'll have a bit of turn in the demand cycle also. So a turn in demand plus, stock level getting to normal and hopefully hopes of some restocking from dealers starting somewhere middle of next year is what, is the sign which we are watching that, okay, that's when we have to start buying the stocks. A lot of times the stock market actually goes up and the stock prices go up much ahead of the fundamentals turning very, very decisively. It's where people think that the incremental news is going to be positive. That's when the stock prices start moving up. So, we are watching for that, not yet buying them, but probably over the next, 3 months, 6 months, we think somewhere we'll probably start nibbling into these names. What we'll buy is probably both the large cap and the small cap look attractive. Most of the time, when the turn is very decisive, then the smaller companies will do much better than the larger companies. But I think the first step will probably be for the larger companies. What we tend to do here is rather than think of the smaller cap or the larger cap, we're thinking of where's the leverage more. If the demand recovery goes back to normal, where will the big leverage coming in earnings and EBITDA and net profit level if we see demand running back to normal? So it's where the capacities are in place, where they're running at low utilization. And so, if demand recovers, then huge operating leverage can be made. Those are the companies which, we are really focusing on.
You go, just a quick word. Yesterday, the governor said that the CAD actually for Q4 may fall below 1%. In fact, we are also getting a sense that going into the budget too, the deficit and the prudence will not be, diluted in any manner, the fiscal prudence. And then, of course, the focus on growth, particularly tilted towards rural may come. Is it in the price yet? Or do you think that it's already kind of, it's not priced in yet?
So, in general, the reason we are quite bullish on India over the next 3, 4 years is that there's a lot of macro stability. So, the twin deficit which used to hurt us is no longer there. It's like, we are moving to more and more fiscal constrained regime where, progressively we are reducing our fiscal deficit. The current account deficit is no longer a big constraint. In fact, if anything, at some point you would think that the rupee will appreciate if it were not for the efforts of RBI to keep it under control. And we probably don't want it to appreciate, just given that a lot of our trade competitors are not appreciating the rupee. But otherwise, there's a lot of macro stability in the country. There's probably some political stability and reforms are progressing in a steady manner. So to that extent, that provides the backdrop why the markets, have been doing so well, where on most dips, people want to buy the market. And that is what has probably kept valuations higher than normal.
All right, Jyoti, we'll let you go on that one. Thanks so much for joining us today.
If you like this video, then like, share and subscribe to ET Now.